If your goal is to be debt-free by the end of 2024, stick around to this video to find out how. In today's episode of Ask MFG, we're going to be discussing debt and really what we can best do to avoid debt going forward, as well help you come up with some strategies in order to pay down debt as fast as possible. And debt's become a pretty hot topic, especially with interest rates being incredibly high or higher than they have been in the past couple of years. So Carlo, why don't you get us started on what our viewers should be focusing on about debt?
Thanks, John. Yes, let's get into debt. Now, let's first, before we start talking about strategies how to get out of debt, let's talk about the different kinds and is there good, is there bad debt? So what are we talking about? There's credit card debt, bad debt. There are lines of credit, could be good or bad. There are loans, whether it's for a vehicle, whether it's a consolidation loan, and then you get to mortgages. Essentially, people are going into debt because they don't have the funds to pay for certain things at the time. But again, I did mention that there are good debt and bad debt. And there is an order at which to put yourself in a better financial situation that you want to be paying that debt down. Now, to put yourself in a better situation, you want to pay off the highest interest rate bearing debt first, which typically would be credit card debt. In some cases, that can be up to 25%. And as John mentioned earlier, we are in a high interest rate environment where lines of credits and loans, whether you're financing a vehicle purchase or leasing a vehicle, those interest rates are getting up into the 9-10% interest rate level. The last of the debt facilities being a mortgage. And typically mortgage rates, because they are secured by equity in your home, they're the lowest interest rate bearing facilities that you would have. Those would be the ones that you'd look to tackle last.
Absolutely. And like you mentioned, with these different styles of debt or different types of debt we have, it all comes down to, obviously, you don't want to spend above your means, but we do know things come up from time to time. So if you have got yourself into this position where you are indebted, whether it be credit cards, line of credit, one strategy that maybe would be best to utilize is a form of debt consolidation. And you'd be surprised how frequently we come across it, where if you have, let's say, an extra $50,000 to $100,000 of available debt on your line of credit and you have $20,000 of credit card debt, it just makes sense to move that from the credit card over to the line of credit. Reason being, as Carlo, like you touched on before, credit cards you could be paying upwards of 20+% of interest. Very difficult to get out of that, that cycle of continually paying down interest. One way you can do it is just put it all on the line of credit and service the debt at a lower rate, hypothetically with the line of credit being somewhere between 7 to 10%. So little strategies like that do help us get ahead of the curve, because we don't want you to be at that point where all your payments are just going to interest. The banks are going to love you, you're helping pay them, but we want to make sure that you're focusing on paying yourself and paying down your debt first, and doing so in a lower interest rate environment like a line of credit is a better solution than paying off those credit cards.
Ideally, you want your money working the hardest for you.
Correct.
And if you are paying down credit card debt, which is at 23%, you're getting a rate of return on your money at whatever the interest rate is on that debt facility that you're paying off. So try to get rid of that consumer debt first, credit card to line of credit, loan. Once that is paid off, either look to pay off the mortgage or start an emergency fund.
Yeah.
There's no sense in having an emergency fund sitting in a bank account that's earning 0.5% when you've got debt on a debt facility that's charging upwards of 20%.
Correct. Yeah. The main strategy here is get ahead of the curve. That's what developing an emergency fund is. So it's almost like preemptively paying down debts that we know are going to happen at some point, whether it be something that happens with the car, something that happens with the house. Expenses come out of nowhere, come out of the woodwork. We don't want you to be putting that onto a line of credit and having to pay 7 to 10%. We'd rather you have it in an emergency fund. At least maybe it's earning 5% over the course of time while you're preparing for this, unknown debt to come up, and at least have that money there in order to pay it off and to avoid having yourself dip into additional credit.
That's great, John. Again, these are just some strategies to help you get out of debt sooner than you thought you could. Let us know in the comments section. Are you currently in a situation where there is high consumer debt? Where are you putting your money? Into an emergency fund, or are you paying down that debt? Let us know in the comments. Again, as always, if you do like the content, please do subscribe to our YouTube channel or just give us a like. Until next time, I'm Carlo Cancino.
I'm John Iaconetti.
And this has been Ask TMFG.